Hello and welcome to Safe Stocks. I am Tanushree Banerjee, editor of Equitymaster's Blue Chip recommendation service, Stock Select. It seems the unending lockdown phase has turned novice investors into expert traders. And why not? Gaining a few percentage point of returns from stocks each day or even each week, even as you go about working from home or doing household chores, seems so much productive, especially at a time when almost 8 out of 10 stocks that you've bought have not surprised you with any negative returns. Yes, that's the story of Indian retail investors turned day traders today. Most have fared far, far better than even the legends when it comes to investing performance over the past 3 months. Even well-known hedge fund manager like Stanley Druckenmiller admitted to having missed the recent rally. Speaking of Druckenmiller, let me tell you an interesting story about him. In case you've never heard of him, he worked for George Soros when the duo famously bet against the British pound in 1992 and made massive profits. But here's what happened in 1999 at the peak of the dot-com bubble. Stanley Druckenmiller bought the tech stocks well before they peaked. He sold everything in January 2000 and was sitting pretty with his profits. But two of his office interns were still trading in tech stocks and were making a neat 5% a day. Stanley couldn't stand it. So he again put billions of dollars once again into tech stocks almost at the top of the dot-com bubble. And needless to say, he ended up eroding his entire portfolio over the next couple of months. Why am I telling you this? That's because in this video I'm going to show you 3 charts that every investor must see today, irrespective of whether you're an investor or a day trader, a novice or an expert in the stock markets. These charts will tell you why there may be many investors out there who are making the same mistake that Stanley Druckenmiller committed in 2000. And in case you haven't made these mistakes, what is it that you should be doing to keep your portfolio safe? So let's get started. First, here's some proof as to why the bull market of the last 3 months is extraordinary. Going by the data of previous market crashes and subsequent pullbacks in the years like 1992, 2000 and 2008, the latest pullback can be called the quickest bull market in history. Nothing wrong with that, but we must figure out if there are stocks that have run up too much too soon. So let's take a look at our first chart. If you remember, the pre-COVID lockdown phase was already a trying time for the economy, and sectors like auto were feeling the heat of lower GDP growth. Sectors like telecom and pharma were already in a structural downturn due to regulatory headwinds. And therefore, these were primarily the sectors that did not participate in the Sensex rise to 41,000 levels earlier this year. However, over the past 3 months, these very sectors have become the newfound love of the stock markets. Not that there's any good news on the economy or the regulatory front so far, but stocks in these sectors have comfortably outperformed even the Sensex. That is not to say you can't find value bargains in these sectors today. You may still find a few, but you've got to be careful, as these pre-COVID value sectors have pretty much caught up with their fellow indices over the past 3 months. Next come the small and mid-cap stocks versus the blue chip or even the BSE 500. Now most investors out there weren't willing to touch small caps even with a barge pole until COVID-19 struck. No doubt the correction that ensued made many small caps extremely attractive, and a significant portion of fresh liquidity into the markets flowed into the small caps as expected. But here again, the average 40 to 50% gains in small caps leave very little upside on the table in the near term. So, buying stocks without a deliberate attempt to look for quality businesses could be very risky. And finally, how big has been the quickest bull run? Is it just a handful of stocks that have multiplied, or were the gains across the market? So, the third and the final chart is to show you that 83.9% of all the listed stocks that have actively traded on the stock exchanges since 23rd of March that is the day Sensex crashed 13%, have gained significantly till date. This is exactly why investors and traders who are new to stock markets have had a superb experience over the past 3 months, as almost any and every stock has given them phenomenal returns. The problem is that this experience may not be lasting unless investors now take a careful look at their portfolio and literally sanitize them to get rid of the unwanted elements. What do I mean by that? Well, desperate times call for desperate measures, and plenty of businesses out there are taking advantage of the COVID-19 situation to creatively show profits on their books despite the stressed business environment. So, it's extremely crucial to beware and recognize the false profits, all profits that would not sustain once the macro environment turns to normalcy. Cheap liquidity. Thanks to the loose monetary policies of both the US Fed and our very own RBI, interest rates are currently at 15-year lows. And cheap liquidity often leads to excesses when companies borrow beyond their means to fund acquisitions or expand operations without keeping their cash flows in mind. So, despite the benign interest rate environment, do look for companies that prefer lean balance sheets and not cheap liquidity. Allocate right. Yes, I can't emphasize enough that a quick bull market cannot be a reason to forget about your allocation to blue chips versus mid and small caps. I have shown you a suggested allocation pyramid here, which you could of course fine tune as per your risk profile. But please do not lose track of your allocation or go overboard on risk for high returns. And finally, instead of looking at the Sensex or sectoral analysis, go for stock-specific bargains. Yes, you heard me right. Even in the current markets, it is possible to come across a handful of stocks that continue to offer attractive bargains, especially when you consider the quality of their businesses, the strength of their financials, or simply their ability to tide over the crisis. So keep your focus only on those stocks and you are likely to come out stronger even on the other side of the quick bull market. Want to know more about the stock specific bargains I'm recommending to stock subscribers? Make sure you read about them in Equitymaster's free newsletter, The Profit Hunter. And do share your experiences in this quick post-COVID bull market in the comment section of this video. Thank you. Take care.